All right, folks, good afternoon. Today is Monday, May the 9th, 2022. And I know it's not the middle of the week. I know it's not midweek. Normally I try to do a midweek update. And I know it's not the weekend yet. Normally I try to wait to the weekend to do a market review. But as this market continues to sell off and things continue to unfold, I think it's important for me to share with everybody who follows me um, the unfolding events, or should I say, or as this market accelerates, I want to keep you guys updated as the action happens, so that you guys can adjust yourselves accordingly. And I thought this is very, very crucial for me to do a quick review, real quick, to show you guys what transpired on the day, and just look at the technicals and show you what the technicals are showing. Um, Technicals are showing that this looks just like a falling knife on the weekly and even on the monthly chart. So this is something worth really paying close attention to on a daily basis as you decide what positions to take and what positions to get out of. Now, I want to start by real quick showing you guys the breadth of the market. The breadth of the market tells it all, folks. If you can look at the breadth of the market, you see where most of the money is leaning. That tells you, to stay on that side, lean towards that trend. If you try to fight that trend, you're going to get burned if you're trying to, fight a trend that's not going in your direction. This is a daily chart of the SPXA 200R. This is the chart or the tool that tracks the S&P 500 companies trading above their 200-day moving average. And as I told you guys in the past, let me switch to a more cleaner version of this tool. At this tool, you can go back in history and you can see, let me do you can go back in history with this tool and you can see what it does when it gets to a level of between 90 to 95, the market starts to sell off. Okay, and you can see when it's one of the extreme sell-offs, which is what I think we're experiencing now. We were trading with this tool had 97% of the S&P 500 companies trading above their 200-day moving average back in May of 2021. Look where we closed at today, folks. On Monday, May the 9th, 2022, almost a year later, went from 97% down to 30%. Look at the 30%, 0.30, folks. And my actual target, you see, I got it marked down here. I think we're going down to 0. I think we're going to see the same type of capitulation in the stock market that we seen back in 2009. Just not sure if you're going to get a bounce here anytime soon, and this is going to wash, or this going to wash out quickly. Don't know, but I think ultimately, even if we get a bounce anytime soon, I think we'll sell off again until we get back to 0. I think we're going back to that 0 level. Very close to that 0 level. We hit close to that 0 level back in 2020 when we had the COVID plunge. We got close to the 0 level back in 2018, but we didn't quite get that low. But we did in 2020, and we definitely did in 2009. I think we're going to see the same thing. This sell-off is starting to intensify, and I'm going to show you guys what you can look for in the markets to see that it's intensifying in almost every industry. When we start to see some of the big companies like Apple start to really intensify, then the bears are digging their teeth in. Once Apple, really starts to, people start to dump their stock on Apple and really see Apple maybe even do like Amazon did, down 30, 40, 50, 60, 70, 80, even 80%. Once we see a steep sell-off on Apple, then we may be getting close to that bottom for that time frame. Then we got to see what happens. Looking at this tool, I still use RSI and all my other tools. We're in oversold territory on the wins percentage and the full stochastics. But look, RSI is not in oversold territory yet. That's my technical tool on the bottom. It is not in oversold territory yet. Still showing around 38 on this particular tool. And if we look back in 2008 and 2009, 2008, we got down to oversold territory on this particular tool. And I think we're going to hit that oversold territory again, folks, on RSI with this tool. So continue to watch, monitor this. This is the breadth of the market. Again, I think we possibly could be heading towards that 0 mark. And that could happen sooner than later. And then we have to see what happens after if we hit that level. I did have this 30 level marked on another chart as a level of level of support. So we could see a bounce here. It's just hard to say right now. All we know is the bears are in control, and you just gotta trade the trend, don't fight the trend. All right, now let's take a look at matter of fact, let's look at a daily chart of this tool. Here is my ultimate target. Well, my first target on a daily chart is that if we hit this trend line, and you see we got as low as 28 back in February. I think we're probably heading to that 28 level again. So we're probably heading to that 28 level again. So that means we got a lot more room to go, or a little bit more further to go on this tool, which we could see sometime this week. And then we got to see if we get a bounce or not. Really not. I'm really 100% not sure if we're going to get that bounce right away. So I've been sticking with the downside, folks, for the past 6-7 months. I've just been playing the downside, and the profits have been generous. That's all I got to say. The profits have been extremely generous with this downside play that I've been playing. So that is the XPXA 200R. Now, let me draw your attention to another way you can take a look at the breadth of the market, and this really tells the story. So if you guys are friends with me on Twitter, you know I have this Wall Street Journal tool or easy link to this particular Wall Street Journal tool on my Twitter page. And if you guys are watching this for the first time, if you don't know my Twitter handle and would like to follow me, I'll pull it up real quick so you can see it for yourself. And here's what my Twitter page looks like. It says God's Child Tim. So at God's Child Tim, and then have this link pinned to this Wall Street Journal tool that shows you the new 52-week highs versus the new 52-week lows. Now let's take a look at that tool, because this really tells a story. When you have more, whichever one outweighs the other. So if you got more new lows being created than new highs, then that means the breadth of the market is very negative and very bearish. If you have more new highs being created versus new lows, then that means the market is more bullish. People are trading more bullishly and looking for a higher move to the upside. So let's take a look at this tool. Look to my left, you'll see there's two selections here, and right above that, those selections, you see new 52-week highs and lows. Very first selection, you'll see New York Stock Exchange, NYSE. The next one you'll see is NASDAQ. Okay, the first one we look at is New York Stock Exchange. So they show the new 52-week highs first. So this tells you how many new 52-week highs were created today. Look at that, 28 new 52-week highs. That's a very low number, folks. Now let's scroll down to see how many new 52-week lows were created. And I saw this, my jaw like to drop. I mean, my lip like to drop to the ground, hit the floor, seeing how big of a difference it is, which shows you that everybody is selling this market like crazy. Everybody, every computer, everything. So let's scroll down. Look at that, 1,730 new lows created today, folks. This market, the bears have sunk their teeth into this market and is not letting go. Has no intention of letting this go just yet. So if you're still a buy and hold investor, and I'm gonna show you, if you're a buy and hold investor, a lot of folks say, well, I'm a buy while the market is going down. That's great, but when is it going to end? And then not only that, if I show you some history, you'll see that when we had such a sell-off like this, even before 2008, 2009, back in 1999, 2000, there was a big sell-off as well. I looked at the lows back in 2000. It took 13 years for those folks who were jumping in this market as the market was falling. It took 13 years for those folks just to break even. So yeah, you can buy this market as it's falling, but how long is it going to take for you to recover from those losses? How long is it going to take for you to see a profit? You know, why not just learn how to play the market on the downside? If you know how to short, if you know how to, sell options against the stock that you own, do that. If you know how to just buy put options, do that. If you know how to do put spreads, do that. Do whatever you know how to in order to continue to have a gain in this environment. Because if you don't, if you're a buy and hold investor, you may be buying these low price stocks, and you may look at your portfolio a year later and still not see a realized gain or realized profit, because what if it takes 13 years for you to actually go back to that level that you bought at and for you to just break even? So keep that in mind. The bears are really sinking their teeth into this market. So again, we show 28 new 52-week highs and 1,730 new 52-week lows within the New York Stock Exchange. What about the NASDAQ? Let's switch over to that. So here's the NASDAQ. It's not letting me switch. God dang it. Hold on a second, folks. I'm sorry. You know what? The one I just showed you guys was the NASDAQ. So that, okay, let me see. I can tell by looking at some of these stocks. So the one I just showed you guys, that was actually the NASDAQ. So let's go back to, so and that's still an extreme. Now let's go back to the New York Stock Exchange. New York Stock Exchange, here we go. Only 12 new 52-week highs versus, drum roll please, 1,063 new 52-week lows. Again, you can see that the breadth of the market is leaning more bearish, without question, without a doubt, definitely more bearish than bullish, and it doesn't like we are seeing any type of turnaround anytime soon. Now, let's take a look at the since futures are running. I'm gonna show you guys how this market can be very tricky. Look at the Dow futures right now. Dow futures up 96 points, up 96 bucks. It was nice and green right now, and we could see, not saying it's going to happen, but you could see a rally of 600, 700, 800 points, not 1,000 points, and people might think that's a good time to jump in. I would beg to differ. Be very careful, because these big rallies have been sold. And while we're talking about that, let me show you guys, or get your guys' attention on this daily chart of the Dow Jones. One thing I'll point out. Now, I changed my red line, which used to be a 200-day. I changed it to 250-day moving average, because I've seen that seems to be a more well-defined area in such a volatile market to look for breakdowns and breakouts. And this blue line is my 50-day moving average. We're starting to cross below that 250-day moving average, folks. That is extremely bearish still. And everything is just starting, all the moving averages starting to point downward. That is extremely bearish. Even in oversold territory on the full stochastic win percentage, the market is still selling off. That's a huge sign that this market is really starting to accelerate and move to the downside. Now look at the weekly chart on this tool. I mean, on this Dow Jones futures chart. We are nowhere near this 250-day moving average on the weekly chart. And I do believe we're going to reach it. We're going to reach it eventually, sometime this year. So watch out for that. That also shows me that there's still more room to fall. When price action hasn't found, we already broke down below major moving averages on a daily chart. Weekly chart shows much more room to fall towards that 250 day, and I think we have a chance to hit it. Just like we broke right through it. Look to my left, broke right through it during the COVID plunge, right through it. So I think we got a chance to even march down to that 250-day moving average and possibly break right through it. All right. Now let's take a look at the VIX real quick. See what the VIX did on the day. And I told folks to watch out for this VIX, because the VIX is gearing up for a move towards 40 bucks. Now here's a daily chart of the VIX. Here's this trend line I've been telling you guys to watch out for. We have tested this trend line several times over the past 6 months. Within the past 6 months. And every time we have tested that trend line, we pulled back. The most recent time was back here in beginning of May. We hit it, pulled back. Now we're running up to it again. You think we're going to fail again? I doubt it. I think we're going to blow through it. I think we're going to blow through it, and we're going to see if that happens, we blow through it and hit 40, really going to see a big washout in the overall market. And then you can start looking for possible support in the market. And I would say possible short-term support if we get a bounce, because if you look at the monthly chart, let's look at the S&P. Look at a monthly chart of the S&P. It does not look promising for longer-term price action. And I drew all these lines, and I'm about to get rid of these lines because they're all irrelevant at this point. If the market is just in free fall, seems like. So I'm getting rid of these lines so you can see clearly what price action is doing, what price action is showing us. I'll just leave the last one, which is the COVID line, which is where we are. This last line I just left, that is a support area where we started to pull back during the COVID plunge. So I'm looking for price action to at least hit that level on this monthly chart. And if you look at the RSI on the monthly chart, RSI is still around 50 on the monthly. I think that's going to get all the way down to 0. I mean, all the way down to 30, I'm sorry. So I still see over the next couple of months, we continue to trickle lower until we possibly hit on this on S&P, till we possibly hit below 4,000, folks. I mean, we have a very good chance to hit. I mean, we're already below 4,000. What am I talking about? We had a chance to, yes, S&P, we're already below 4,000. So we could see 3,500 in the S&P, folks. That's a possibility. We can get down to 3,500 in the S&P over the next couple of months before this year is out. So keep that in mind as well. All right. Now, another thing I'm starting to notice, sorry, and even even the TTM squeeze on the daily chart, it looks so dire. Look at that. TTM squeeze, like it's just a complete trend to the downside. We just continue to small bounces, then pull back, small bounces. We're just starting to really, I mean, the move to the downside is starting to accelerate. And I think we may be in this for a minute. All right, let's take a look at gold, because somebody asked me about gold and silver. And true, I do believe that gold and silver is a good inflationary hedge, but when everything starts to sell, that's another sign. I mean, even gold and silver, it's been hard to catch a bid in this inflationary environment. And here is my trend that I drew for a possible breakout on gold. But folks, gold is having a hard time catching this bid, and we're right back to a support level. If this does not hold on gold, it could continue to pull back. So we got to see if this hold, we get this bounce here. But if we continue to get these bounces in gold at this this level of support, we could eventually see it break out of here, but it may take some time. As long as the market is still, showing this big steep downtrend, and the dollar itself continues to show strength, it's gonna be hard for gold to start to get that bounce. Now, looking at a daily chart of gold, it's starting to challenge this 250-day moving average. That's not a good sign. So we got to see what happens here. And we got the 20-day moving average, which is this gold line, starting to dip below the 50-day. That's also not a good sign for gold. And silver is the same. Someone asked me about silver. Silver is the same. Other than it's already below on the daily chart. It's already below its 250-day moving average. And we have the blue line, which is the 50-day, crossing below the 250-day. That is a complete bearish signal. Now we are at a level of support right now. Price action is, so we got to see what silver does there. But I'm sticking to playing the overall market to the downside, and I'm staying away from a lot of bullish, trying to play this market in a bullish fashion. Just don't want to do it right now. It's just too risky. You'll fare better playing this market to the downside right now until the trend changes. All right, so gold and silver doesn't look well right now. And look at crude oil, it's just been all over the place. And I'm not sure what crude oil is going to do. Crude oil is back to a level of support. So we got to see if it's going to get that bounce. Here's crude daily chart back to the 50-day moving average. If we break this, folks, if we cannot, we bounced off of this 50 days several times since we challenged it. If we break that 50-day, I would expect to see crude accelerate down to about $83. So again, it's once we find that there's no place to hide in this market, then we know that the gig is up. If we can't find nowhere to hide in this market, bulls can't find nowhere to hide in this market. Can't find a way to hide in gold, can't find a way to hide in crude, can't find a way to, to hide in silver. That means that, we could be looking for the capitulation that everybody is talking about to start to, show its ugly face, where everything just sells off, and we really start to see, stocks really tread lower, quicker, faster, much more fierce. So I think that's all I wanted to show you guys, folks. Stay vigilant. Be careful if you are a buy and hold investor. Consider learning ways to play this market to the downside, because this will definitely hurt you. And let me show you guys what I mean by it could take a while to recover from such a dire pullback. Go to the Dow Jones, because we see the same type of action that we seen back in 2007 or even 2000. It could take a while for you to recoup those gains. So here is a monthly chart of the Dow Jones. And let me go to a max because I want to point something out specifically. Let me get rid of a couple of these lines here so you guys can see exactly what I'm showing you. So all these lines appear pretty much irrelevant to me because I think we're just going to continue to just push low over the next couple of months. Every rally we get in the near term, I think it's going to be sold. Let me go to a let's do, bear with me folks, I'm trying to give you guys something you can reference. Okay, we'll do it like this. So this is actually it's good enough. Okay, so this is a yearly chart of the Dow. Let me just gonna highlight a couple things. So look to the left of my screen, right around here, you see these 3 red years in a row. That was 2000. So right around where I got this trend line drawn, that was around about the highs we got in 2000. Then we pulled back. Okay, so here's 2000, here's 2001, 2, 3, so on and so forth. So from here to here, which is 2008, that was 8 years. So it took about 8 years for the market just to get back to this level that it fell from back in 2000. Maybe it went up just a little bit more, but there was no real money made. So then we pulled back again. Look at this big pullback right here, 2008 to 2009. And then we rallied again. And right where this trend line is, right where I got this circle, that's where the folks who started to drop back in 2000, that's when they really started to break even and make money. That was almost 13 years, folks. 13 years for them to make money. The folks who started buying money during the drop in 2008, okay, so they started buying here and it dropped down to here in 2009. It took them from 2008 up to 2013. So it took them 5 years to start to see a realized gain. Why not play the market on the downside, make money on the downside once it starts to reverse? Then you take those profits from your puts or from your shorts and you put it back into the market, make money on the upside. That way you never lost a beat if you learn how to play this downside of this market. Now, look at where we are now. What if for some reason we start to pull back and we go all the way back down here to the 2009 breakout where we broke back above this trend line? What if we go back down and test this trend line? That would be a heck of a pullback, folks. So nobody knows how far and steep this is going to go. But I do know this: we have definitely been in overbought territory on the longer term monthly charts for a number of years. So it could be a while. It could take a long time for that to unwind. But needless to say, even if we just pull back, half of what this is, you see how long it took for those folks in 2009 and 2000 to recoup those losses. It took 13 years. So if you just only know how to play the market on the upside and you're buying right now where this big red candle is, and we continue to, to sell off for the next couple of years, if it takes you 13 years or longer to recoup those gains, that means 13 years you have lost where you haven't made any profit. That's not a good mix. Learn how to play this market on the downside, folks. All right, I think I showed you guys everything I needed to show you guys. I'll be back probably midweek. If there's any big rallies or if there's any other big sell-offs, I might be back midweek just to take another look at it. But I'll definitely be with you guys later on during the weekend to show you guys my market review. So we can see where we at. So we can see where we stand by the end of next week. One more look at the monthly chart. Here is the monthly chart of the Dow Jones. As you can see, we are starting to roll over. You see that like a horseshoe. We're starting to roll over, upside down horseshoe, starting to roll over. RSI is still nowhere near oversold territory on the monthly chart, which is where I think we're going. All right, folks. I will catch you guys on the next video. Be vigilant, be mindful, and be careful.